Axel, what's going on?
How we doing, man? Glad to be back.
Yeah, so this is the second repeat guest on the show, and I wanted to bring Axel on for a few reasons. One, he's one of our newest coaches at Freedom Framework, our rebrand from Fully Funded. And in his coaching and that side of it, he'll really focus deeply on how to go buy multifamily, manage them the right way, finance them. And I think he brings a really neat perspective, right? We've had people on here who syndicate large projects, right? Projects that are 50, $100 million and have massive teams and scale. And I think that's a great route for some people. But if you're looking at one of the most simple, most tried and true ways to go replace your corporate income with cash flow through ownership and equity, I think what Axel does is very repeatable, very sustainable, and I think he's one of the best at it in terms of finding off-market deals that are direct to seller at below market values.
Absolutely. No, I'm excited to hop into it and dissect how we can actually create some cash flow in a much more tangible way than going out there and raising money and doing these large deals, which I think is oftentimes the frequently discussed path into multifamily investing on podcasts like these. So excited to share the alternative approach, which obviously has been a focus of mine in our business.
Yeah, and I think at times people get really excited with metrics that don't matter, right? I think people look at two big things which don't actually impact you in a big way. And those are AUM, right, in terms of number of dollars of deals you own, and two are total unit count. And I think what you're going to walk through really highlights that there are other metrics you can look for when you're looking at how can I go replace my corporate income really quickly and own more of deals yourself. So, I want to give the listeners a little bit of background in terms of the types of deals that you do and kind of how you think about it.
Absolutely. So high level context. I personally live in Boston, grew up about an hour north of Boston in New Hampshire, which is where we buy 95% of our real estate deals and basically where our headquarters is from a real estate company standpoint. Been buying since 2016, got into it late college, didn't have a lot of money in the bank. And for me, the solution was I need to go out there and find great deals, which the easiest way to find great deals or most predictable way to find great deals is to go direct to seller and compete with fewer buyers, get in front of the owner before he hires the broker, and secure great pricing that way, and find more compelling opportunities than what you would find on the MLS or through publicly listed platforms. Um, First few years was buying a lot of these deals with private financing that I was the sole owner of, basically working with private lenders, hard money lenders, and bridge lenders to get those deals closed, creating some value, refinancing, and pulling my original investment out and rolling that into the next one. And basically rolled that snowball down the hill, metaphorically speaking, until 2020, 2021. Basically got up to around 80, 90 units that I personally owned. And at that point, wanted to scale a little bit more and kind of do what you briefly alluded to start the podcast here, which is raise some money and go down the syndication road. Did a handful of those deals in 21 and 22. But by doing those deals and actually getting into those deals, quickly realized that the pursuit of the metrics you're talking about, unit count, AUM, oftentimes there's a disconnect financially in terms of you think that there's more money on the other side of syndicating a 50 unit deal, a 100 unit deal, what have you. And when you actually sit down and do the math, or when you get into those deals, you very quickly realize there's almost no cash flow for sponsors. And there is money at the end when you sell and you actually close it out, you return capital to your investors, you get into your promote, you can make money doing so. But all your compensation is at the end of the deal. And it does require a sale at some point, typically, to really materially impact your finances getting into a deal like that. And until then, money's going out in your co-invest and in your pursuit costs, and it takes a while for it to come back. So to make a long story short, did a handful of those deals. We bought 300 units that we syndicated in New Hampshire in 22 and 23. And we still do syndicate some deals. However, my pendulum has swung back to the side of the business where I'm back to prioritizing deals that I personally buy with my own capital and resources, or very simple joint venture deals with a partner or two, but we're having material percentage of the overall equity. And we're actually have the ability to generate more cash flow in a shorter period of time comparatively to these syndicated projects. So in general, to kind of close it out, we typically buy 5 to 75 unit properties throughout southern New Hampshire. We do own some real estate in Florida, but we bought that back in 2020 through 2022. Not a major focus of ours anymore. We are very hyper focused in southern New Hampshire, kind of within an hour radius north of Boston, basically up to the southern part of New Hampshire and then up the coastline. Smaller deals I'll do myself, which I'll define as the 5 to kind of 20 unit range. Stuff that's 20 to 75, start to get into working with some partners, and towards the top end of that range, that's when we'll still go out there and syndicate those deals so we can actually get those closed. But in those deals, I'm a pretty meaningful co-investor, so that I'm contributing on the economics, both on the LP side, and then I have my upside on the GP side. And then we also own a management company as well that's based in Manchester, New Hampshire, which manages about 750 units right now. So manage my units, and then we also manage some third-party units. And that's what the business looks like today, primarily in terms of what we're working on.
So walk us through the economics for you personally, right? In buying, say, an 8 unit deal yourself versus going out and syndicating. I know you just actually recently closed on one of the bigger deals you've done, right?
Yeah,
What was
we
that?
did.
15
Yeah.
or so?
Yeah. So it's interesting. And I think there's a lot of variables, but what I'll do is kind of strip away a lot of the more less important variables to kind of streamline how to think about buying a deal yourself with your own capital or syndicating a quote unquote larger deal, which I guess is relative depending on where you're at and what you've done in your business thus far. But I like to use 5 units and 50 units as the two examples, right? Um, let's say you're investing in a market where deals are trading at $100,000 a door, 100K a unit, just for round numbers sake. You can go out there and you can buy that 5 unit deal for 500K. Or let's say you go out and you find this 50 unit deal for $5 million bucks. A lot of people think, okay, let's go out there, let's go syndicate that big 50 unit deal. A lot of units under one roof. I'm going to go raise the money. It's, economically, this has to make more sense. When we actually start breaking down the impacts of both, you very quickly realize that it's a significantly shorter road to meaningful cash flow doing a smaller deal with just your own capital than doing a larger deal. So, for example, 5 unit deal, let's say you go out there and you get 80% loan to value, just for round numbers here. You get a loan for $400,000. You got to put $100,000 into that deal as an investor. Again, you're going to have closing costs, but we'll simplify the example. Let's say you sell that property in 3 years and you sell it for $600,000 and you make 100, right? You get the bank back their 400 and you got 200 left over. So you double your investment in a few years. Great outcome. And obviously you were probably collecting cash flow along the way because you're entitled to all of the net proceeds from that deal in terms of the net cash flow. That's what you're collecting after paying your debt. You're probably earning somewhere between 100, 150 bucks a month. So you're probably making anywhere $500 to $750 a month in free cash flow. Now let's go take the 50 unit deal. So you're going to go get a loan for $4 million, 80% LTV. You got to go find $1 million to get that deal closed. Now, if this is your first time doing a deal like that, you're probably going to have a hard time raising $1 million. You're also going to probably have a hard time signing on a $4 million loan and having a bank feel comfortable lending you $4 million, right? Unless you have plenty of experience or you've already got a big balance sheet. So you're probably going to need to find a couple partners to help you get that one closed. And let's say you just do a very simple 70-30 syndication, or a syndication with a 70-30 split above some type of preferred return. Your LPs are going to get 70% of the profits. You're going to get 30%. Same outcome. You sell it in 3 years for $6 million bucks. Bank gets their 4 back. You got 2 left over. Million goes back to your LPs. And now you have this $1 million in profit. Well, 70% of it, again, going to your LPs. They get 70% of the profit. Now you've got 300K. And you're thinking, cool, I made 3 times as much as I did on that small 5 unit deal. But again, you probably had to bring somebody into the general partnership to help you sign on the loan. You probably need to bring somebody into the general partnership to help you raise that money, unless you had those folks in your network. You had to operate a much larger deal if you were the one doing so, and it does take more work operating a 50-unit deal than a 5. It doesn't take 10 times as much because you do get some scale, but it's certainly going to take you at least twice as much time and energy to oversee that. And maybe you had to compensate someone in terms of bringing somebody in who has the operational experience to manage that. Let's say best case scenario here, you get half the upside. You get half of that 30% GP promote. You made 150K. Great. Now you might be thinking, I still made more in this small deal. But what I think people fail to realize is that in syndicated deals, you typically have some kind of preferred return. Maybe it's 7%, maybe it's 8%, maybe it's 6. You're offering a low one. But in most cases, specific to multifamily, basically all of your cash flow that you're earning from that project is being paid to your LPs to satisfy that preferred return every year. And you're not really going to see any cash flow as a general partner throughout the hold period until you get to some meaningful refinance, maybe where you're returning a large chunk of capital, and then it's making it a little bit easier for you to hit that prep. But generally speaking, in most deals, it's not like there's typically going to be excess cash flow that the GP is earning in those situations. So it's likely you didn't collect cash flow over those 3 years, and you made some money on the back end. But again, you had to spend a lot more time on that deal, and those deals are significantly harder to put together, to find, to finance, to raise the money for, to oversee, than just going out there and buying a 5-unit deal with the similar economics. So while that was probably a very long-winded explanation, it's important to realize that just because it's a larger building, 10x the unit count, doesn't necessarily mean the economics are even similar, right? I mean, in this situation, you're making a little bit more, but you are spending far more time putting that deal together and finding that deal, or finding it then putting it together, than you would just buying a 5-unit deal with your own resources. And your capital is going to be required in both situations, which is the other piece I forgot to mention, is you're going to have to co-invest to satisfy the bank, to satisfy your investors. You're going to tie 100 grand into both of these deals. And again, one is a much easier roadmap to go down, or one easier road to go down than the other. So I learned that after doing a bunch of these and realizing after we sold them, like, it's, it's a shorter road to cash flow if I continue buying my own deals that are 5 units, 8 units, like the one we just did, 10 units, finding the good deals, using a little bit more debt to put them together, less of my own cash, but you're stacking cash flow in a much shorter period of time.
So I think it also a really simple way of looking at this too is how many deals above 50 units did you buy in 2024?
Just one in 2024. Just did one over 50. Yeah.
How many deals below 50 units did you buy in 2024?
16 deals. So we
So
did 17 in total. Yeah.
that's part of it too, is that buying these smaller deals, there's way more of them in general. You're competing with less sophisticated buyers that may not want to go buy deals that size because they have to go deploy larger chunks of capital, right? They don't have the systems and process to go cultivate off market leads. I think when you look at, if you had to generalize, right, and say at market value, those 16 deals that you bought, if you had to go trade them again immediately once you did it, once you closed,
Yeah.
what percent versus market value do you think you were actually at?
Yeah, I mean, with those deals, a big criteria on the buy side for us is we want to be buying like 15% plus below day one, market value at the day of close, before we're getting into any renos, business plan, any of that. And so to directly answer your question, we could have turned around the day of closing and relisted all of those, and post closing costs, both on the buy side and the sell side, still made money. And that's, the biggest hedge that you can have as an investor is buying with that type of margin, and with that type of margin of safety. And it's also the easiest way to supercharge your invested capital, because you're earning that bump, that return day one, before you're actually into the business plan and actually sending more dollars out to execute that business plan.
And if you're looking at how can I go build a portfolio that cash flows for a long period of time, and how can I go cycle my capital, right? Velocity of money is a huge thing. Bigger deals usually, right, rule of thumb, take longer to get to the business plan than smaller deals. Big
Mhm.
deals usually don't trade at a massive discount versus market value, especially not to people who are newer getting into the space. Or if you're a very seasoned investor, you've done dozens of deals at a certain size, and there's a short sale going on or a broker has to go, they have to go move, and you're one of the first calls, maybe you can get stuff cheaper than someone else, but not all, at a massive spread versus market. If you're buying these smaller deals versus what the market should price them at, right, you have the level of bump in terms of what it's worth versus what you're paying. And you look at the model of how quickly can I go increase value through either increasing rents or decreasing operating costs, increasing efficiencies, or just managing the asset more efficiently than it has been before. that lift of getting it to a place where the NOI supports pulling out cash via refinance through a higher appraised value is likely a far shorter time period. Meaning that if you can go invest your 100K, get your 100K back, and walk us through a few deals you've done in terms of that timeline for deals you've executed well on. In terms of you buy a deal, you increase value in some way, and then you go recycle your own cash, and you can go reallocate those dollars and still keep your ownership in that same deal and or cash flow.
Yeah, 100%. And you described it really well, right? Doing a big deal is like turning a cruise ship. Um, and it just makes it significantly harder, especially if you're raising capital, because again, now you have a fiduciary responsibility to your investors in which you're not as nimble in terms of the decision making process as you would be with your own deals. And so, a good example of this, um, I think we closed this deal. Let's see. So we closed a 23 unit portfolio back in December of 2023. So this is 2 years ago, but I'm going to walk us through kind of the process in doing this. So direct to seller deal, we bought 23 units, right around 100 and change a door. I think our total price was 2.4. All from the same seller, retiring owner, wanted to get out of the business, like just didn't want to do anything with it anymore. And what we did was we bought that property with a combination of bridge money or bridge debt and hard money. So one of the properties we used hard money lending, high LTV. The other one, bridge debt, slightly lower rate, but still pretty high LTV, a little bit over 80%. Me and a partner, we bought it. We just split it 50-50. It was a very easy deal to get closed in terms of the moving parts. And we both just own half the deal, right? We both just have half of that one. And we go in there, we do our business plan. We spend $10,000-$15,000 a unit, depending on the units themselves. Part of our loan that we got was they were going to extend renovation financing. So we don't need to bring that capital to closing. We're drawing it down with the loan. So we're still keeping a very small chunk of our dough in that deal. We basically brought more or less 300 with closing costs to get it closed, 150 each, not a large investment. And we ended up selling one of those three properties. And this is a little bit more of a complex deal. But again, the thought process still stands, where we were all into it for 130 a unit, and we ended up selling it to the next guy at 155 a unit, an 11 unit building that comprised the portfolio. And we netted, I believe, on that sale, 600,000 or 700,000. So more than the capital that we had into it, plus additional, we cashed out additional proceeds. And then we could use those dollars to go and finish the business plan in the other 12 that we had. And we just refinanced that, and we were paid even more, right? And we refinanced that into longer term debt about 18 months in. We closed it a few months ago. And long story short, we were in a situation where we paid 2.3. We had roughly 350 into it. So we were all into all the units, right in the high twos, somewhere in the 275 range after closing costs. And we sold one of them for 1.6, and the remainder of them are worth right around 1.9, $2 million, right? So we created nearly $1 million in equity on a deal that we bought for 2.3, and we only brought 300 to close the day that we closed, and we created $1 million in equity, a 3x in basically 2 years. But what's powerful with the strategy is that we had the optionality. We could have refinanced all of them. We could have taken all of our original invested capital out plus some, invested in the next deal, and kept it rolling. We decided to sell one of them and pull out even more than we originally anticipated, because we wanted to take some off the table and then refi. We knew we were going to refi. We could pull some more off a little bit later. But at a high level, deals like that are nearly impossible to execute at the institutional level in terms of finding those types of spreads, because again, as you mentioned, it's an efficient marketplace with more sophisticated players who have a lower cost of capital and who are much better at deal sourcing and executing than a lot of the folks who are looking in this smaller range. And to make that even more of like an applicable example, it's significantly easy. We do a handful of these deals every year. A lot of them I personally buy, as we talked about, as we just mentioned. We did 17 deals in 2024. The average unit count per deal that we bought was right around 9 units. So we did a lot of smaller stuff at like 3 to 6 units. We had a couple of bigger deals that pulled that average up. But if you start spending really any reasonable amount of time on a weekly basis, which I define as like 5 to 10 hours, being you're ahead of 95% of real estate investors, you start to develop an off-market deal pipeline where deals are coming to you, whether you're going direct to seller or just building really quality relationships with agents and other investors who can refer you deals, to where you can go out and buy a 6-unit property that is worth 800 if it was listed on the MLS, and you could buy it for that 650, 675, where you have that margin the day that you close. And when you do the math, when your all in cost on one of these smaller deals is 75% of market value, if you pay 600 and invest 150 into a building, you're into it for 750 and it's worth $1 million. Well, you go out there, you get a loan for 750 and you're pulling out all of the original invested capital that you have in that deal. And that's the supercharged nature of real estate investing that allows you to rapidly grow that portfolio in a significantly compressed period of time, that allows you to do a handful of these deals in a given 12 months or in a couple of years span, to where you're not tying up so much of your own investable dollars in those deals. And that allows you to do that, 10 units the first year, 20 the next, 30 the next, with you being the sole equity owner of all of those units, versus passively investing into a large community with another sponsor, or being the GP who's putting that together but can't get to the finish line for 2, 3, 4 years, as we just talked about. So a couple of examples, but generally speaking, that's the approach that we take in our business that allows us to cycle our cash really quickly.
Yeah, and also think about it too. Something you mentioned is the ability to go sell off units when you buy a portfolio deal. Like when you think about the timeline to sale and the buyer pool that you'll have when you go to sell a building that is 6 units, 8 units in your local market, like how many potential buyers do you usually see in a transaction like that? Or like how long would it take you if you're like, hey, I need to go free up $300,000 to go do this deal that has better opportunity, and I have to go sell off one of these assets. How likely are you able to sell it off, and how long would it take, and what's that buyer pool look like for you usually?
Yeah, I mean, it's a significantly larger buyer pool for something that's, call it, sub 10 units than something that's set 100 plus, right? And part of it is because you have all of these different types of buyers. So, for example, when we're selling a building like that, I feel pretty comfortable. The day that I call, one of the brokers that I work with, who we sell properties with, like, here's the rent roll, here's the financials, what's your opinion on a list price? In terms of that conversation starting, couple weeks to get it listed, another week or two for showings, sign a contract, 60, 75 days to close, right? It's typically a 90-day process, start to finish, from I want to sell this building to we're closing this sale, assuming that, something wonky doesn't happen in terms of the actual contract itself falling through and we get the right buyer the first time. But in terms of the buyers who buy stuff like that, you have all kinds of different folks relative to the world of larger multifamily, which is like syndication groups, ultra high net worth individuals, of which there's obviously a smaller number of those, relative to the people that are buying smaller deals. And then maybe when you get big enough, you have like institutional buyers, like maybe like
Sure.
REITs. And it's there's just not nearly as many of them. And frankly, they're all pretty much going to be in the same general range from a price standpoint. It's very rare that you get one of these very sophisticated buyers to just be like, I'll pay way up here, and all of the other people are down here. It doesn't really happen often because they're all relatively similar in terms of how they underwrite, how they approach the deal. Unless there's a very special situation with one of them, they're typically going to be in the same general range from a dollar standpoint. Now, on the flip side, on the smaller end of the spectrum, we say this, like, 5 to 10 unit, 5 to 20 unit range. You're going to have first time investors who are just, buying that first real estate deal. You're going to have existing investors that focus in kind of that range from a size standpoint. You're going to have non full time real estate investors like the doctors, the attorneys, the high income earning business owners that want to put money into real estate. They'll just go buy a deal, they give it to their property manager, whatever. You have people that are doing small 1031s where they got their little duplex or 3 unit. Now they're going to sell it and go buy 6, 7, 8 units. But basically, the point being, there's such a wide range of how these people underwrite or manage that there's a significant variance in the types of offers you get. And it makes it a little easier to catch someone at a time where you're actually securing a much higher offer relative to maybe what that market value would be at that property at a given time. So, for example, you have the doctor who's like, I'll go buy 5 to 10 units a year for 5 years or whatever. And, that's going to help supplement my retirement, and I'm going to self-manage them. Like, that guy's going to underwrite in a totally different way than maybe the sophisticated real estate investor who might be looking to buy some smaller stuff, but they're pricing in management and they're pricing and hiring maintenance guys to do the maintenance and all of that. who's also going to underwrite it very differently from the person who's got their duplex that they house hacked and now they're going to sell it and 1031 into their 5 unit deal. These are three different approaches to underwriting, and some might come in really low, but others might come in really high because they're just a little bit more inexperienced. So while the numbers are obviously smaller in terms of what you're selling these properties for and the money that you can potentially make, it's much easier to capture capture the incremental value in the margins here. We can buy at the right price from a motivated seller, and then you can sell to a buyer who's a little less sophisticated, that may be underwriting a little incorrectly and is willing to pay a little bit more than market at a given point in time because it makes sense for what their goals are and what they're trying to do, which is very different than the larger side of the spectrum, where it's just everyone's underwriting to a very fractional decimal point and kind of getting around the same range in terms of what they're willing to offer.
Yeah, that's just a huge point too. Like just the buyer pool you have in terms of sophistication, in terms of where they're at personally, in terms of what their goals are and what they believe they can go accomplish with that deal. You just have such a wider range of people. Also, a big point too that I don't think you mentioned just yet is that people buying those deals for 3, 6, 8, 10 units likely already have the capital raised because it's their own
Yeah.
money. When you get into these bigger transactions with syndicators, something we see is that the ability to go close and to not retrade and to get to a place of money is actually in your account can take a very, very long period of time and also may not happen at all, right? What we're seeing right now is that raising capital is harder than it has been in many years. And people at times aren't coming through on their equity raise, right? So you may go through a full sales process to not close, right? It's that person buying a deal that has the money already there. There's a huge value in taking that project to go sell that person in the first place.
Yeah, I mean, we really just ran through that whole gauntlet on this deal that we just closed, our 72 unit deal that we bought for right around 50 million bucks. We had to raise, four and change, which maybe to some folks listening is a small raise, maybe to others it's a big raise. It's all relative, but we had a hell of a time getting that capital raised, and this was right around the election season too, which didn't help, right? Because everybody likes to use that as an excuse to not make a decision from an investment standpoint. But yeah, those deals are significantly more challenging to get done, and that was a 4 month contract period, where we basically had to trigger a couple of extensions with the seller to get that deal done and closed. And it's the inverse dynamic for sure when you're doing these smaller deals where you can just ask for more too upfront in terms of like a buyer vetting standpoint, right? Like your broker, I mean, you can ask a guy who's pursuing a 6 unit deal for $1 million, in terms of what you're selling it for. Like, can you send us a proof of funds? Show us you got around the down payment that you probably need to get this closed. And yeah, sure, here you go. Like, that's a really standard part of a transaction like that, and allows you to get into a contract with a lot more confidence. And those deals are significantly less complex from a financing standpoint as well, in terms of needing less third party reports. The bank underwriting process or the lender underwriting process is typically going to be significantly more streamlined, both as it relates to the deal and the borrower. Inversely, like, these large multifamily deals where people are going out there and getting agency financing, it's typically like a 90 to 120-day process right now. And it's likely that something will get screwed up along the way. So I think that there's increasingly becoming a growing gap between the mechanics of the deals, the underwriting of the deals, and the players who participate in both segments of the market, from the small range, which I'll define as kind of 5 to 20 units, and the big range, which I'll define as 100 plus. Mid size is what I would define in the middle, 20 to 100 or so. And they're almost like not even really comparable segments of the marketplace anymore in terms of the difference in approach in getting those deals done, both in terms of the challenges with capital raising, the challenges in getting debt closed relative to the last, at least as long as I've been in the business, the last 9 years. And the small range is just very different, right? It's so much easier to create opportunity, create margin, less competition, much simpler transactions, as you just mentioned as well.
And it's something too, like when you look at these bigger shops, right, that are going out and taking down 20, 30, 40, $50 million deals, they likely have a lot more expenses they incur to go take those deals down, right?
Yeah.
Meaning they have larger teams, they have more burn every month, every year in terms of their staff. And at times, those groups are most forced to go do deals to go keep the lights on in terms of collecting fees. Whereas if you're buying these smaller off market type projects, you can go create a lot more value much more quickly. like on your end, kind of simplify the numbers too. You know, how many units do you think you had to have on your end that you owned, right, or transactions that you did to get to that 10K a month in terms of cash flow?
I mean, probably right around 40, 50 units get you to about 10K in cash flow in the market that we buy in, which is, so people can kind of make comparisons. Anywhere from 130 to 175 a unit is kind of like the market value of the assets that we're buying. And after we put money aside for reserves and we pay our management team and we actually correctly underwrite the P&L and we don't do it with two kind of rose colored glasses on. It's right around 40, 50 units in terms of 200, $225 a unit in free cash flow. Like that's typically what we're seeing in the deals that we do and what consistently we can project after we stabilize the building moving forward, which is an extremely achievable number to get to in a short period of time if you spend time, energy, and resources on finding great deals, structuring them well, and relentlessly recycling your capital. Um, and I've seen so many investors, both in my market and then in other markets, create that cash flow or get to that portfolio size in a 2-3 year period of time or even less because they spend time doing the right things and they're focused on the right activities, which is typically the deal stuff.
And that's also including, no big capital events as well, right? That's in terms of
Yeah.
just pure ownership having deals like that. If you go back to numbers Axel mentioned earlier, right? They bought 16 deals this year under 50 units a piece, right? Probably 5, 6 deals in total of that on average gets you to a place of that 10K a month in terms of yield, right? And you can do
Yep.
things differently too in terms of, taking less capital out of them to go recycle and for more pursuit costs, right? Doing more deals, more volume, but it's a very clear path to getting to a place of we can buy a handful of smaller deals, right? We can then use that cash flow to go free ourselves from the corporate world, where give us that optionality, and then from there decide what strategy do you want to do to go grow longer term, or do you make this more of a lifestyle play? But I think it gives you that optionality to go decide what really makes sense for you, and you can also get the route that Axel went too, right? Doing a bit of everything in terms of
Yep.
syndicating bigger deals, right? To get some exposure there, mid-sized deals in terms of JVs, and smaller stuff owning all of yourself because there's truly value there as well too.
Yeah, and to go all the way back to kind of the top end of this conversation, right? I think the vanity metrics oftentimes uh, make it really hard for people to get out of their own way. Where you're obsessed with unit count, you're obsessed with AUM, you're obsessed with these metrics that you think give you more validation in the marketplace. When in reality, when you think about who the wealthiest real estate folks are, and this is, I guess, me speaking anecdotally in terms of who I'm around, who I see, actually creating the most cash flow, creating the best lifestyle design too, which is obviously something we want to be concerned about here as well. And, that's probably why we're getting into real estate. We want to create a lifestyle that we have a lot of control over. It's the guys who, over time, maybe they're working with some partners, maybe they're syndicating some deals, but a large percentage of their deals they're doing with their own capital and they're buying them at the right price. They're quickly refinancing their money out and they're continuing to grow a portfolio of assets that they themselves control that over time they continue paying down the debt, increasing their cash flow. And for example, like the city of Boston is just there's thousands of these guys who have bought these um, you know, 3 to 10 unit deals and grown portfolios of 50, 67 units over the course of 5 to 10 years. And they did so, which is quick in a high price market like Boston, but they've created immense cash flow in doing so. And I think oftentimes, again, we forget that when we're doing these large deals and we're syndicating deals, we're committing time to those deals in perpetuity. We have to spend time doing investor relations. We have to spend time prepping the tax returns and doing the K1s and distributing those at the end of the year to our investors. Um, it's a fundamentally different ownership approach as well because we have these investors that are relying on us to generate returns and we have to be mindful of our reputation. We can't take the same kind of risks that we might be able to. We can't be as aggressive as we might want to because of the fact that we're raising capital. And it's an entirely different business model from a time dedication and investment standpoint than I'm going to go out there and grow my own portfolio where I just answer to the person in the mirror type of situation. So when you're going out there and actually developing, all right, how do I want to, what lifestyle do I want to create? Understanding that if I'm going to go the route of trying to do these large deals and chase those vanity metrics, it also comes with significantly more time and that's required to be invested after we get those deals closed in perpetuity, as long as we own those deals, comparatively to I'm just trying to buy stuff myself, which I think is a component of that decision making process that people sometimes forget as well.
Yeah, that's a whole different conversation to whether you want to or don't want to have investors, right? If you
Yeah.
are looking to go into this space and you want to do it from a standpoint of how can I have the most freedom possible, even if financially you get to a place and you do have that freedom, you still have a duty to your investors to go act as their fiduciary, right? To go be responsible with their money, right? To go give them quality reporting on what's going on in the project and to be there and available to go answer questions they have regularly. And it's something that it's a whole different path depending on what you want to go do, right? So I think it's really important to go think about what do you want your life to look like before you decide which route you want to go in terms of what type of deals you do, what type of investors you take on, what type of capital you take on, what type of structure of deals you do. There's not a right or wrong answer. It's just understanding what the end outcome you want to have can really help guide you on the steps you take ahead of time to get there.
Yeah, 100%. And what's nice is that you can do both, right? I mean, I did both and I tried both and I started to understand how I wanted to segment my business in terms of I'd like to do a slightly increasing percentage of deals myself. I still want to go and raise money for deals because we have the deal flow and it makes sense. And again, you still make money obviously doing those types of deals, but it's just you have to understand all of the implications of making a decision one way or the other, whether I'm going to try to do deals with my own capital or I want to raise and do deals. And you could do both. You could do one, you could do the other. A million ways to skin the cat and make money in real estate and create cash flow. But one of the roads is significantly more predictable, especially early in your investing career. And I think that's the other piece of this too is if you are like, I definitely know I want to go out there and raise money, right? I'd love to do these bigger deals. I want to build a really large real estate business where we have thousands of units under management. Um, and you've listened to everything that we've talked about in this podcast episode. You're like, I still want to go do that. Great. It's much easier to start raising money and to get that ball rolling after you do some deals with your own money too, which I think is like a whole nother dynamic of this conversation where going from zero to I want to go buy that 50 unit deal, raise the money and operate it, that's so much more challenging than going, all right, I'm going to go buy the 5, I'll buy the 10, maybe I'll buy a 6, whatever. I got 16, 20, 25 units that I personally own. It is far easier to raise capital. It is far easier to build the relationships with the individuals who are going to bring you that 50 unit deal. It's far easier to get the lending closed. Like, it's really hard to go and do those deals unless you've done this stuff anyways, in terms of doing a few of the smaller ones, unless you purely want to be a capital raiser, again, which is a different conversation. But that's another piece of this as well. And I think that message gets lost oftentimes in the social media world and in podcasts where it's like, you want to skip the small deals, you want to jump into the big deals, you want to scale faster. But it's actually much harder to do that if you haven't proven out the model in terms of I've done a handful of these smaller deals in a given market and I have a better story to tell deal finders, lenders, and potential equity investors.
Yeah, it's also easier to go make mistakes with your own money than someone else's too, right?
Yeah.
Like
Yeah.
you have no boss at first, right? You're doing your own money. If you lose money on your own deals, your cost of capital and your cost of loss is exactly how much you lost. Right? If you
Yeah.
go have a deal that goes south with investor capital, your costs can be exponentially higher relative to the actual dollars lost because it's investor capital, right? Whenever you have leverage, whether it be leverage of debt, leverage of investor capital, you have obviously higher potential, and you also have much higher potential for things to go wrong there as well in terms of reputation, risk. So all those things to consider as you start building out what I want to go do. And I think the route that Axel has gone is the easiest to go follow with the highest likelihood of success to get to a place of optionality. And then from there, you can really decide, hey, do I want to go bigger? Do I want to do something else? Do I want to go, you know, build this more? And it allows you to give to that place of clarity by doing it for a period of time and getting to a place of financial stability first.
Yeah. 100%. Yeah. I mean, uh, obviously, I think a lot of folks that get into real estate, right? Their fundamental objective is I want to create cash flow, create freedom, quit a job, do this, do that, or work less. And if it's not quitting your job, and yeah, the easiest way to get there is spend time, energy, and resources into figuring out how to be a great deal finder, developing the skills of finding deals, right? And there's very specific things that people can focus on to develop that skill. Um, so that you can predictably go out there and buy that $500,000 property for 400K, or buy that $1 million property for 800, 825, whatever the number is, so that you're creating that immediate return when you close, recycling your cash. And then as you work through that process, you become a better operator of real estate. You probably start meeting people in the market that you can start maybe raising money with or partnering with on a very small level, while you still own a big percentage of those deals, and you're still creating cash flow by doing that. But it all comes back to being able to consistently find discounted deals, discounted opportunities. And when you really start boiling it down in terms of, there's this whole amorphous, vague world of, I want to get into real estate, I want to start buying deals. What am I supposed to focus on? Where am I supposed to go to learn this stuff? It's like it can be comforting in knowing it's very, very clear what I got to work on, and I got to be able to find great deals, and it really narrows down where you're going to spend your time from an education standpoint, and then you extrapolate from there, in terms of the skills that you have to acquire after that. But if you become proficient at doing that one specific thing, then you're shortcutting the path to growing a meaningful portfolio from a cash flow standpoint significantly, right? And that's the roadmap that the people who scale the fastest fundamentally follow.
Yeah, I think you nailed it, right? I think that's just super helpful in terms of diving into just a route that's not talked about enough, right? I think people need to look at what route they want to go and really explore that and see what makes sense for them and kind of what they want to do. And I think this is one of the most tried and true methods that works, right? To go build a level of cash flow quickly, right? To get to a place of just optionality and really deciding what you want to do from there.
100%. Yeah, I mean, it's the beauty of the real estate business, right? And then you probably get into it, and you probably start to pivot and adjust and do this and do that, and maybe you want to go and, you meet a partner here, you find somebody over there that can help you out. But it all comes back to the same fundamentals, which makes it easier. It makes it less intimidating to learn this whole process when you understand that there's really just a few variables, a few different components of the business that you should be really dialed in and focused in developing from a skill set standpoint. And it narrows down kind of the very, there's a million roads that someone could take when they get into real estate, whether it's small deals, big deals, what types of deals, what market, how do I underwrite, how do I do this, how do I do that. When it's like, when you narrow it down, like, I gotta get to 15 units, I gotta get to 20 units, I gotta get to 25, whatever the number is, to create that monthly cash flow. And then I narrow it down even further into, okay, I just got to get really good at finding these deals so I can stretch the resources I have to begin this journey with. You start to make significantly more progress, for sure.
Yeah, that's just a way better cash flow metric too, is how much reoccurring stable cash flow do I have versus how many units do I have, how many dollars management do I have, right? The AUM and the unit count will not help you leave your job, right? Having
Yeah.
recurring cash flow that is predictable, that is stable every single month will allow you that option of saying, hey, do I want to keep doing what I'm doing? Do I want to go focus more on real estate? Do I want to go focus on buying a company? Do I want to focus on whatever it may be? But the unit count, the AUM will definitely not do so.
No, I mean, well, there's always this, like, there's a really commonly used phrase in the commercial real estate world, the real estate private equity world, I should say, of you can't eat IRR, which is like, it doesn't matter how good the IRR is on your deal. You only get to take those dollars off the table and go buy food the day that you sell it. And in the interim, you're not really putting a lot of dollars in the bank. And I know that you're probably familiar with, you probably know a ton of real estate operators who have significantly sized portfolios from a unit count standpoint, AUM standpoint, but like, they're just like dollar to dollar, paycheck to paycheck, trying to get to the exits of those deals. And there's just not money coming in on a frequent basis, really. And the only way that happens is when you raise truly a lot of capital, 8 figures plus of capital, and you're starting to earn some asset management fees. But it's fee based; it's not even cash flow based in your projects
Yeah.
typically, which is, that's a really stressful world to be in. I've been in a version of that world a couple of times myself when we made that pivot, which is why I started to start doing these smaller deals to continue creating that cash flow for myself and the business. But it's very true. It's easy to find yourself where you might have 500, 600, 700 units, whatever the number might be, but it's not translating to dollars hitting your bank account every month. It only translates to these big checks and very infrequent timelines.
And it's also something to think about too, is that if you're investing with someone, you want that sponsor to be in a place of extreme financial stability,
Yeah.
right? Not living super lavishly, but just they're very stable. They're not making financially driven emotional decisions from a personal place in that deal. Like, for example, I like stress in the work environment in terms of getting a deal done or getting a product out or delivering a certain objective, but I do not operate well under personal financial stress, right? If you're in a place where you're worried about like feeding your family, your next meal, paying your mortgage, paying your rents, right? Doing something personal, and you have a raise going on, I'd say there's more likelihood that someone may do something that's unethical, right? Or do something that doesn't feel right if they're in a position where they're desperate personally, right? So by getting to a place of stability, whether it be through smaller deals, whether it be through buying a small company, whether it be through, whatever it is in terms of a recurring cash flow, you then operate from that place of stability, right? Make decisions that are solely based on the long term for you, your business, your investors, etc.
Yeah, I mean that dynamic has not it couldn't have been more prevalent in the last couple of years where a lot of sponsors are like I I need to access the equity that's tied up in this property now to more or less keep my business afloat, even if it's at the detriment of maybe the investors that are participating in that deal, where it may make sense to make decisions X, Y, or Z, hold the property longer, exit at a more advantageous time period, maybe make a member loan to the deal to bridge us a little bit farther. And the fundamental reason that we're investing in real estate is because it's a longer term investment, right? We can make money in the short term by buying these great deals and maybe you want to sell them, et cetera. It's nice to have that ability, but it's far more tax advantaged. You're giving away less of your returns to all the vendors involved in a real estate transaction. If you're able to really think about the decision to buy, sell, or refinance without the stress of like, I literally need money to be hitting my bank account right now, or I'm going to have massive problems, which I think is unfortunately a dynamic that a lot of folks have kind of found themselves in 23 and 24 from the 21, 22 days of buying deals. Luckily not us thus far, and I'm knocking on wood here, but that's very much a dynamic that you would like to avoid. And it's more easily avoided when you have recurring cash flow that you can rely upon, which is challenging to get to for a lot of folks, but it's extremely beneficial once you get there.
It's also easier to like go back to your example of the 5 unit versus the 50 unit, right? That 50 unit property at $5 million, if it needs a chunk of capital to be reinvested into it,
Yeah.
maybe that's $500,000, right? Going back into a deal. That 5 unit building, maybe it's 50K, right? And it's a lot easier to go find that 50K than it is to find that $500,000, even with investors. In terms of going back to
Yeah.
investors, what we've seen is that even making a capital call on a deal, they're not always successful in terms of being able to actually go raise the money from your investors, in terms of giving them the confidence they need to go re-up with you and go further.
Yeah, I mean, a roof on a 5 unit deal is 20K, and a roof on a 50 unit deal is 200K, right? That's 10x, right? You have 50 heating systems versus five. You have it's one of those things where if you mess up your underwriting, as you mentioned, the ramifications are extreme because who should be the first line of defense in a larger deal that is starting to have trouble is the sponsor or sponsors, if there's multiple, in the form of some type of member loan to protect their investors from needing to make a capital call and to protect the integrity of the deal and the potential of the deal. And unless you're in a really stable financial position, as we've been talking about, if you don't have that ability, well, you're significantly jeopardizing both your co-investment and your equity investors' capital. And it can get out of hand pretty quickly in a large deal if you don't have some type of war chest behind the scenes to leverage, which not a great position to be in for sure.
Yeah, but I think this was an awesome breakdown too of just the numbers behind going smaller, going bigger, right? The actual sponsor compensation, what goes into a deal, how quickly you can go cycle. And I think, Axel's done an awesome job of diving deep into understanding this is exactly how you go find deals off market. This is exactly how you go manage them the right way. This is how you go buy them the right way. And this is how you cycle capital really quickly to get to a place of stability. And then in that place of stability, you can get clarity on what you want your business to look like, right? For him, he's made a few pivots in terms of going bigger, going mid-size, and also going smaller all at the same time, and kind of fitting different parts of the market into those projects.
Absolutely. No, I appreciate you having me back here, and excited to continue chatting about it within the group. And I'll just shamelessly plug too for the investors who want to learn a little bit more about multifamily, learn maybe some of the more tactical stuff behind the scenes of what I was kind of talking about in this episode too, as it relates to like finding deals and operating deals, putting them together creatively. host a podcast, Multifamily Wealth Podcast, which is a great place to get some really quick kind of tactical advice on how to grow a multifamily portfolio. And then at Multifamily Wealth on Instagram as well, where I'm pretty regularly posting content too.
Yeah, and if you're looking to go invest in the New Hampshire area too, definitely reach out to Axel and then the management committee there too. But
Yeah.
cool, man.
For the folks out there who know where New Hampshire is, we'd love to have you in our deals. If you don't, reach out to me. I'll educate you on where New Hampshire is and why it makes sense to invest there. But yeah, no, we've carved out a nice little niche for ourselves up there in the Northeast.
Cool, man.